The first $100 you deposit into a bank turns into almost $1,000 inside the system. This is not a conspiracy theory or anything like that. Be patient, you'll understand in a moment. You know the money you see in your bank account. In reality, that money does not exist. This is not something said just for effect. It's not a metaphor at all. And it's not the kind of claim that people who say conspiracy theory love to mock. In the literal sense, it does not exist. If one morning, everyone who had money in the bank went to their bank at the same time and said, "Give me my money," the system wouldn't last even a few hours. It would collapse. Because the truth is, that money is not sitting in the bank. Physically, it is not there. And this is not a mistake. It's not because the system is broken. On the contrary, it was designed to work exactly this way. What we call the global financial system has been built on this from the very beginning. It's such an old, deeply rooted method that today everyone accepts it as normal. This is called fractional reserve banking. It is the silent but real engine behind global debt, inflation, and why we feel rich. Once you truly understand how it works, you realize this: money, from the very beginning, has been built on promises that cannot all be kept at the same time. To understand where this came from, we need to go back to a time when everything was not just numbers on a screen like today. We need to go back to medieval Europe. Back then, money was gold and silver. If you were wealthy, you had coins in a chest, or jewelry you could trade. But the world was not safe. Walking around with bags of gold was a serious risk. You could be robbed or killed. So people started leaving their valuables with goldsmiths who had strong vaults. In return, the goldsmith gave them a piece of paper. That paper said, "If you bring this paper, you can take your gold back." After a while, people realized something. I don't actually need to take the gold. This paper does the same job. Because everyone knew that the paper represented gold, and it was much easier to carry. So when people traded, they started giving these receipts instead of gold. This is where the real breaking point happened. The goldsmiths noticed something. Not everyone came to withdraw their gold at the same time. Let's say 100 people had deposited gold. On a normal day, maybe one, at most two, came to take it back. The rest of the gold just sat there in the vault, untouched, unused. When the goldsmiths saw this, they got an idea. If no one is taking their gold, I can use it. They started writing receipts worth twice as much gold they actually had. They lent these extra receipts out with interest. In other words, they made money from gold that did not exist. As long as everyone didn't demand their gold at the same time, there was no problem. No one noticed. This was literally creating money out of nothing. And this was not a small trick. This changed everything. The moment everyone accepted paper promises as valuable as gold, money completely detached from physical reality. Banks were born from this practice. Over time, the system was legalized, regulated, and institutionalized. By the 1700s, even governments adopted this system. The Bank of England was founded in 1694, but its purpose was not to serve the public. The British Crown was constantly at war and deeply in debt. The bank lent money to the government that it did not actually have and charged interest in return. These debts were not repaid with loot from new conquests. They were repaid with taxes collected from the people. Does this sound familiar to you? It should, because the exact same thing is done today. Governments borrow money that does not exist and make people in the future pay the price. The United States applied the same system. Early American banks issued banknotes convertible to gold, but very quickly they realized something. We can print more paper than the gold we actually have. From time to time, bank runs happened. People panicked and rushed to the banks. They said, "We want our money." And in that moment, everyone saw the truth. The money wasn't there. Banks collapsed overnight. But instead of abolishing the system, it was strengthened. Central banks were created. The message was this: even if the money isn't there, we will make people believe that it is. Now, let's bring this to today. Let's say you go to a bank and deposit $100. Naturally, you think that money is sitting in the bank. but the bank only has to keep a small portion of it. In the past, this ratio was 10%. That means the bank keeps $10 and lends out $90. The person who receives that $90 spends it. The merchant deposits that money into another bank. That bank keeps $9 and lends out $81. This cycle repeats again and again. In the end, your original $100 turns into almost $1,000 inside the system. But here is the critical point. The only money that actually exists is the first $10. Everything else is debt. Every new unit of money in the system is born with someone's obligation to repay it. And now things become even more striking. In the United States, even this 10% rule no longer exists. Since March 2020, the required reserve ratio is 0. Banks are not required to hold anything against deposits. So, what stops banks from lending unlimited money? The answer: Basel rules, capital and liquidity requirements. They are written in the city of Basel, Switzerland, at the Bank for International Settlements, not by elected politicians, but by technocrats. Let me explain simply. If a bank gives a risky loan, it must set aside a certain amount of its own capital. As risk increases, the amount of capital it must hold also increases. It is also required to have enough liquid assets to survive short-term crises. But pay close attention to this. Banks no longer lend deposits. They create the loan first, and the loan creates the deposit. When you take out a mortgage, the bank doesn't take money out of a vault. It writes numbers into your account. That money is created because you agree to repay it. That's why more than 90% of the money in circulation today is not central bank money. It is bank money, money created as debt. And that's why every financial crisis is actually a crisis of trust. When debts are not repaid, the system begins to unravel. This system has 3 inevitable outcomes. First, inflation. As money increases, its value decreases. Second, permanent debt. Because of interest, the system can never fully close. Third, concentration of power. Those who own assets win. Wage earners lose. It was like this in 1929. It was like this in 2008. Each time, the system came close to collapse. Each time, governments and central banks stepped in. Trillions were printed, because without this system, the modern economy cannot function. And the most disturbing truth is this: the system cannot survive if everyone becomes debt-free. If everyone paid off their debt, money would disappear. The economy would stop. So you are both the fuel of this system and its collateral. That's why money is not wealth. Real wealth is land, knowledge, skill, production, and independence. Debt is not neutral. Inflation is not accidental. This is not paranoia. This is awareness. If you don't understand the system, you get lost inside it. If you do understand it, you learn how to protect yourself. And don't forget this: this story doesn't end here, because everything is built on trust, and trust is the easiest thing to lose.